So today we're going to be talking about the changes to the non-domicile and remittance basis regime. As Kay said, our speakers today are myself, tax partner here at RPGCC, and Tanya, senior tax manager. So I'll hand over to Tanya to start the conversation. Tanya, can't hear me. All right, okay, I'll start. So under the current regime, we have a series of tests when it comes to looking at residence and domicile. So the statutory residency tests form the basis of the new regime. So we thought we'd go over those first before we go on to looking at our current position, just to see where the changes are going to come in the future. So the current position under the statutory residency tests, we have a number of tests that need to be considered, and they have to be considered in the order shown on the slide there. So you have to look at the overseas test first, the UK residence tests, and the sufficient ties tests. There are a number of tests involved in looking at your residency, but as a basic rule of thumb, if you are here for more than 183 days in the UK, when I say days, that means midnights, then you'll be treated as UK resident. Now, other ways to look at residence. So the overseas tests, the first test is whether you're working full-time overseas. It's also if you come to the UK for less than 16 days, if you've been here at all in the last 3 years, or less than 46 days if you haven't been resident in the last 3 years. If none of those tests are relevant or we don't meet any of those tests, we'll then look at UK residence tests. Essentially, I say first test is if you've been here more than 6 months. Second test is if you have worked full-time in the UK. And the last test is to do with just having a home in the UK and nowhere else for 3 months of the year. Yeah, we don't meet any of those tests. We look at sufficient ties tests. Sufficient ties is essentially 5 connection factors that we look at to the UK. The more connections you have to the UK, the fewer days you can spend in the UK and still be non-resident. So that's the residency test as they are at the moment. Now there also is treaty residence. So whilst you may be resident in the UK under the UK residency rules, under a treaty with another country, it's possible that you may be considered residents elsewhere for the purposes of tax, for the income tax and capital gains tax for a particular year. So for example, if you are living in 2 countries, living between 2 countries, you might be living in, say, France and the UK, traveling regularly between the 2 countries. If your connection factors are closer to France, even though you might spend sufficient days in the UK to be resident here, under the UK-France double tax treaty, it's possible you may be treaty resident in France and therefore be paying taxes on your income in France and just pay UK taxes on your UK source income in the UK. Other concepts that are relevant at the moment is domicile. So domicile of origin is essentially the domicile you take from your father at birth or mother if your parents were not married. That is essentially your natural home, your heritage, if you like. And with that, it stays with you for essentially your life. So unless you somehow lose your domicile of origin, then it will always revert back to you. So it is possible to have a domicile of choice. A domicile of choice is essentially a choice to live somewhere indefinitely for the rest of your life, effectively. Is the easiest way to think about it. But it's got to be a particular jurisdiction. It's not enough to say, I'm not going to live in the UK for the rest of my life. You have to choose a particular jurisdiction and say, I'm going to live in that jurisdiction. Now, when it comes to a state system like Switzerland or the US, you need to be choosing a particular canton or state. It's not enough to say, I choose a particular country. It's a particular legal jurisdiction that you need to be a choice of living there. So it is quite difficult for someone who has a domicile of origin in the UK to have a domicile of choice outside the UK. It's difficult to evidence that, difficult to prove that. Now, domicile dependency is less common. It's essentially the fact that whilst you're under 16 in England and Wales, 14 in Scotland, that if your parents change their domicile of then effectively yours changes too. So if they were to, this is most common when people immigrate into the UK, you might then have a domicile of choice in the UK, and as you then your children would then pick up that domicile whilst they were minors. It's possible once they turn 16 for them to either have their own domicile of choice in the UK, or if at some point they decide to leave the UK, their domicile of origin would revert. Probably the most important one really is the deemed domicile. So people who have been UK resident for 15 out of the last 20 years will be treated as deemed domiciled in the UK, which will mean they'll be liable to inheritance tax on their worldwide assets. It will mean they can't claim the remittance basis of taxation. So as a non-domicile person, it's possible to claim the remittance basis of taxation, and that basis remains in place until the 5th of April 2025. So we'll still be doing tax returns, including remittance basis claims, for quite some time to come yet. The remittance basis is essentially a system whereby you only pay tax on your UK source income and any overseas income that is brought to the UK in some form. It doesn't have to be in cash. It can be in services. It can be in loans. It can be in assets. If the value is brought into the UK in some way, it is treated as remitted to the UK. Now, overseas workday relief is a system whereby currently for the first 3 years, although there comes changes to this relief shortly, for the first 3 years that you arrive in the UK as a non-domiciled person, you are allowed to be taxed just on your UK work days, and your overseas work days are not taxed unless the salary that relates to those days are again remitted to the UK. Now, there's quite a number of criteria to be met to fulfill that. As I said, it's one of the key benefits of that is normally when you do remit income to the UK, you have to follow a certain ordering rules to understand what you have remitted to the UK, and it can be quite tricky to trace monies through your bank accounts exactly what you have brought to the UK. One of the advantages of the overseas workday relief is that you can look, rather than looking at individual remittances, you can look at remittances for the entire year, and as long as if you have remitted less than your UK salary, essentially, then that is sufficient to prove you haven't made a remittance. So the overseas workday relief has a simplified version of the mixed fund rules available. So that's our starting point. So now we're going to look at what has actually changed.
Sorry guys, can you hear me now? Can you hear me now?
Yes, we can.
Yeah, I can hear you as well. Yeah, sorry, I had some issues.
Okay. So going forward then from 6th of April 2025, the non-dom remittance basis system is going to be abolished. So the remittance basis is going to be retained in some form. It just won't rely on your domicile status. So instead, it's going to become a residency-based system. So for those who have not been UK tax resident in the previous 10 tax years, then they will be able to claim the remittance basis for the first 4 years that they are then resident in the UK. Now, that is the first 4 consecutive years after they start being resident. So if there's a gap, so if you become resident for 1 year, leave, and then resident for the next 2 years, that will be your 4-year window. It won't reset because you've left for 1 year. You have to keep looking at the 10-year test.
Tim, I also add that you should be treated as non-UK residents under the statutory test and not under the treaty.
Correct. Yeah, exactly. So if you're treaty resident elsewhere, that doesn't mean you're non-resident for the purposes of this test. It has to be under the statutory residency test.
Yes.
So for the first 4 years, you can just pay tax on your UK income. The difference with the new system is that it's slightly more generous in the first 4 years in that you can remit the income that arises in those 4 years and not pay tax on it. So you can receive that income tax-free. And as an incentive to bring money to the UK, to invest in the UK, you can remit that money free of tax. So I think we just want to clarify as well what is actually overseas income gains, because certain income may appear to be overseas, but is in fact treated as UK income. So in particular, the one that we see most often is employment income. So there's a sort of a misapprehension, I said, that because you're paid from overseas, that makes the employment income offshore. That is not the case. Employment income is treated as arising where the duties are performed. So you may well be paid from an offshore company, but if 100% of your duties are in the UK, 100% of that income is taxable in the UK and is not subject to the remittance basis. Now, rental income, that sort of thing, depends where the actual property is. So if it's physically in the UK, then that'll be UK resident. If it's physically outside the UK, it'll be non-resident. Now, when it comes to employment, we do have the overseas workday relief. So if you do some of your duties in the UK and some of them outside the UK, then to the extent they relate to your UK duties, that amount will be taxable in the UK, and the amount that relates to your overseas duties will not be taxable. The difference, just to reiterate here, is that under the new system, you can bring the overseas money into the UK. So trying to understand the mixed fund rules, trying to make sure you only remit what relates to your UK earnings will no longer need to be taken into account. You can't just remit the overseas income. The overseas workday relief will also be extended to 4 years rather than the first 3 to tie in with the remittance basis system.
Yeah, Tim, what about the self-employment income? Because this is the most common question. Can I claim overseas workday relief on my self-employment income?
Yeah, that's a good question.
How do I declare as well? Where do I have to declare my self-employment income?
So self-employed income is not eligible for the overseas workday relief. That is specific to employment income. As a self-employed person, your duties are deemed to be in the UK unless all of your duties are outside. So if you do some in the UK and some outside the UK, 100% of that will be considered UK source income and not subject to the remittance basis. Now, if you do some work overseas, you may also have a liability in the country you're working in if you have what's called a permanent establishment there. So that would be if you have an office in that location. It would be if you've got people working for you who can essentially conclude contracts with clients in that particular country, then there'll be tax there. But they'll be subject to double tax relief. So the UK would give relief for overseas tax that is correctly paid in that country. Now, it's possible because of the change coming in from 5th April 2025, that some people who have already been here perhaps up to 3 years may fall into the new regime for 1 or 2 or 3 years. So there could be a situation where some people are currently under the existing non-dom regime, but also may still qualify under the new regime if they've only been here, if they haven't been here for 10 years prior to their arrival in the UK. So you might, for example, have someone who's been here since last tax year 23-24, therefore 23-24, 24-25, they'll be under the current remittance basis regime. 25-26, 26-27, they'll be under the new remittance basis regime. Now, with the change in the basis, anything that you've claimed the remittance basis on before the 5th of April 2025 will still be under the old regime, meaning if you remit that income, you will be taxed on it. So, to take account of that, they've introduced what's called the temporary repatriation facility. So, after the 5th of April 2025, there is going to be the possibility to remit money to the UK or deemed to be remitted to the UK, and just paying a flat rate of 12% for the first 2 years and 15% for the third year. After that, any remittances will be taxed at the full income tax or capital gains tax rates. So again, to encourage people to bring their money onshore, or at least give them the ability to bring it onshore, there is possible to make an election that essentially designates part of your offshore funds as being remitted to the UK and pay tax on that. There's no need to actually physically bring that money to the UK. You can just elect for some or all of your offshore income and gains to be treated as remitted to the UK. That would give you the ability in the future to then bring them in without paying the full income or capital gains tax rates, which could be as high as 45%. So it could be worth considering whether this is of benefit to people to actually bring the money in and take advantage of these lower tax rates. As I say, you can just leave the money offshore. You don't actually have to bring the cash into the UK. Now, where you've got assets overseas which might contain income or gains which has previously been subject to the remittance basis, for example, if you've got an investment portfolio overseas, it may be that you've bought shares, funds, something like that in an investment portfolio with money that previously have been subject to the remittance basis. So essentially, that's the base cost of the shares in that case would contain income or gains that hadn't been remitted to the UK. You can elect for that asset to be treated as part of the repatriation facility and therefore pay tax on that, such that when you sold it in the future, you would pay tax on the gain at that point, assuming you were outside the 4-year window. But you could then remit the funds into the UK without further tax. So there's no need, essentially the point is there's no need to liquidate your assets to be able to claim this basic lower rate of tax on the income and gains overseas. You can just elect to use the assets into the system and pay the lower rates of tax. So it's worth looking at your plans for the future, whether you might need some funds, whether you might want to buy a house, fund children's education, to fund their houses, that sort of thing. Then it might be worth considering electing to pay some tax on that income. No.
Yes, I think we should focus on these temporary repatriation facilities for the following year and discuss with our clients, with our future clients about this option. Because it should be, if something given to you, I think it should be used. What do you think, Tina?
Yes, exactly. Yeah, I think there will be benefits of claiming this for some people. Particularly as you don't need to remit the income to the UK, because if you remit the income to the UK, then the income will also be the cash, the assets will automatically be liable to UK inheritance tax. So the ability to leave the assets outside the UK and make that election is advantageous because you're going to pay a lower rate of tax than you would do if you remit it in the future, and you don't necessarily have to bring it inside the inheritance tax net. So it's definitely going to be worth having a discussion to see if it's beneficial for some people based on their future plans, whether we remit that income or not. So, talking of inheritance tax.
Yep. Nothing certain in life like tax and death.
Yeah, exactly. Yeah. So inheritance tax is a big issue for some people. So inheritance tax is currently charged on UK sited assets. It's also charged on worldwide assets if the person is either domiciled or deemed domiciled in the UK. So at the moment, the inheritance tax regime is very much based on domicile. and therefore it can be quite difficult to interpret and understand what someone's domicile is, particularly because by the time their domicile comes to be questioned, they will have passed away. So the people who are left then have to prove, or if that person may have changed domicile, they may have to try and ascertain what domicile they had. Anyone who's done a domicile inquiry will know the extent to the detail that HMRC go into. HMRC have a special page on their guidance which sets out the initial questions that they will ask people on a domicile inquiry, and there's about 80 questions just in their initial list. And that's not the end of it, that's just the starting point. So you really have to know the detail about someone to understand their domicile. For that's one of the main reasons I would say that they're trying to move away from the use of domicile in the inheritance tax and remittance basis system, because it is such a vague concept and difficult to prove a change of domicile. So where we're going next then is we're going to move on to the very similar basis to the remittance basis, in that someone who has been resident in the UK for 10 out of the last 20 years will be subject to their worldwide assets, inheritance tax on their worldwide assets, I should say. So this change is going to come in from the 6th of April 2025. And it will mean that people who have been here for a long time will straight away become liable to their worldwide assets. This is obviously a shorter period than the deemed domicile period, which is currently 15 out of 20 years, but they're reducing it to 10. So because of the test is 10 out of the last 20 years, it will mean someone will have to leave the UK for 10 full years before they're outside the scope of inheritance tax if they've been here for 20 years, essentially. So the number of years you need to leave to get yourself out of the UK system will depend on how long you've been here beforehand. So as I say, if you've been here for a straight 20 years, then you will need to leave for 10 years to get outside the system. But if you've only been here for between 10 and 13 years, you will need to leave for 3 years. And then it ramps up from there. So if you've been here for 14 years, you need to leave for 4 years. If you've been here for 15 years, you need to leave for 5 years, etc. Until you get to the fact you've been here for 20 years, you'll need to leave for 10 years. So it is possible to get outside the UK's inheritance tax net. The rules regarding assets situated in the UK haven't changed. So assets that are physically situated in the UK will remain liable to UK inheritance tax. That includes overseas companies whose value derives from UK real estate, UK property. So that, if the company derives its value from real estate that's in the UK, then it's likely to be subject to UK inheritance tax, even though the company itself, the shares themselves, are overseas. And that's regardless of domicile status. That's just the fact that it's based on a UK asset. Now, I wasn't going to go into too much detail this time around on overseas trusts, because they can be quite complex and not necessarily applicable to everybody. But I think suffice to say, there was previously the ability to put assets into a trust before becoming deemed domiciled in the UK, or domiciled in the UK, and have those assets outside the scope of UK inheritance tax forever, effectively. So that was called excluded property. Excluded property trusts will no longer be available. So it will still be possible to put assets into a trust before you hit your 10-year mark, and those assets will be outside the scope of inheritance tax. But as soon as you go over your 10 years, such that the person who set the trust up becomes liable to inheritance tax, then the trust will follow suit, and the trust will become liable to inheritance tax as well. Now, when I say liable to inheritance tax, trusts are typically liable to inheritance tax on the 10th anniversary of when they were set up. They're also liable when assets leave the trust. Now, in this particular case, there's also going to be an additional exit charge. So if somebody has an offshore trust, passes the 10 years, brings the trust into the inheritance tax regime, and then subsequently leaves the UK such that the individual set it up comes outside the inheritance tax regime, then the trust will have an exit charge at that point for having left the inheritance tax regime as well. So effectively, the trust mirrors the person who set up the offshore trust. Fine. So what can we do? What's the good part to this? So there is going to be, in certain circumstances, the ability to rebase assets. So that means essentially you may have owned an asset for a long, long time. It will have quite a low base cost, but because it's offshore, that you might have had the ability to claim the remittance basis if you were to ever sell that asset. Now, if you were in that position that you had an asset that you had owned before the 5th of April 2017, you were in a position that you could have claimed the remittance basis in the last 7 years, effectively, between 17 and 18 and 24, 25, then, and you had claimed the remittance basis during that period, then it's possible to rebase your assets to the 5th of April 2017. So previously, once you'd become deemed domiciled in the UK, then the capital gain would have been liable to UK capital gains tax on sale, and you would have used the original base cost in working out that capital gain. So if the 5th of April 2017 value gives you a better answer, then you can use that as instead. You can elect to use that rebased value. So there is some good news on the capital gains tax front, that for people who meet the criteria, you can wipe out part of the gain if the value is higher than the 5th of April 2017 on your overseas assets. Now, what is quite a big change is that previously the remittance basis inheritance tax for UK domiciled people, they were always taxed on their worldwide income, gains and assets for inheritance tax. Going forward, they too, UK domiciled UK citizens, will be able to benefit from the remittance basis if they're returning after more than 10 years away. So the test is purely based on residence. It's no longer based on domicile or citizenship, anything like that. So a returning expat will be able to benefit from the remittance basis for the first 4 years they come back to the UK and not pay tax on their overseas income. Similarly, for inheritance tax, if they're a UK-based person leaves the UK, they too will now be able to get outside the scope of inheritance tax without having to prove a domicile of choice elsewhere, or be based purely on the facts of residency. Again, just to reiterate, that's residency under the statutory tests, not the double tax treaties. So you have to meet those tests, and you can extrapolate yourself from the scope of worldwide inheritance tax and just pay tax on your UK cited assets. Now, as we've discussed as well, you can use the repatriation facility, and it's something we believe that clients should be looking at in the next 3 years to see if it's a possibility, if there's benefits in using that. Then, yeah, we'll have to look at that on a case-by-case basis to see if it's of use to clients. And then just as a planning point as well regarding the 10-year limits, for overseas assets, clients may consider making gifts before they become UK long-term resident. Because if you make a gift before you become long-term resident, then that gift will be outside the scope of inheritance tax. You won't be subject to the normal 7-year potentially exempt transfer limit. You can just make a gift of offshore assets before you become essentially a long-term resident subject to your worldwide assets. The reverse is not true. So if you make a gift now whilst you're within the UK inheritance tax regime and then leave the regime, that gift will remain liable. It will come back into your estate within 7 years if you pass away within the 7 years, even though your worldwide estate at that point may be outside the scope of inheritance tax. Your gift, because you made it whilst you were long-term resident, will be inside the scope of inheritance tax. So just, yeah, it's a question of timing and getting those gifts right. So it's, again, something that can be planned ahead to be utilised. So just, again, to make sure we're clear, we've already discussed the use of trust. When I'm saying gifts, it'd be gifts to family members, beneficiaries directly, as opposed to a gift to a trust in that respect. Okay. So on the subject of inheritance tax, we are planning further webinars in the future. One will be specifically on inheritance tax, as there's so much changes generally in the budget, not just for non-domicile people. And then at some point, we'll also need to consider making tax digital, which is regarding self-employed people, people in unlimited partnerships, so not LLPs, and people who have rental properties who are making rental income in excess of £50,000 to start with, although that will reduce to 20,000 in the next few years. So we'll be doing an introductory webinar to that as well in the not too distant future. So keep an eye out for that. So yeah, so there's our contact details if you want to contact us to any more questions. Let me just see if you've got any questions in the Q&A. So this question from Andrew: is it correct that the new rules apply starting on the later of 6th of April 2025 and the date 4 years after arrival to the UK? No, that's not quite the right way around it. So the new rules will start from the 6th of April 2025. But the point is the finish date depends on when you arrived in the UK. So for people arriving after the 6th of April 25, they'll have the full 4 years of new remittance basis. But if you've already been in the UK for a period, say 3 years already, then you're only going to get 1 year of the new regime, because it's a 4-year window, but it's 4 years from when you arrived, regardless of the fact the new rules only come in from the 6th of April 2025. Okay. Fine.
Tim, Tanya, I'm back. Thank you very much indeed. If anybody does have any further questions, please do feel free to email us at hello@rpgcc.co.uk, and we will come back to you later on today, hopefully. Tim, Tanya, thank you very much indeed.
Thank you, everyone.
Thank you, everyone.